In this recording, I will be analyzing operating assets questions. Now recall that operating assets are assets used in the day-to-day business operations of a company. Examples of operating assets are cash, account receivables, inventory, property, plant and equipment, and intangible assets like patents and copyrights. Now, we will start off with accounts receivable. Now, account receivables are reported on the balance sheet at net realizable value. So let's look at the question we have. At what amount will accounts receivable be reported on the balance sheet if the gross balance is 20,000 and the allowance for uncollectible accounts is estimated at 15% of the gross receivables? Now, if 15% of 20,000 is estimated to be uncollectible, then the net account receivable, what we estimate will be collectible, will be 15% out of 100%. That will be 85% multiplied by the 20,000. That is the net account receivable, and that is what will be reported as account receivable on the balance sheet, and is 17,000. Now let's move on to the next question, which is about the account receivable turnover ratio. Now, the account receivable turnover ratio measures how quickly a company collects its account receivable. Now, the more turns implies that a company is collecting its account receivables more quickly, and that is more desirable. For example, a lender will be interested in the account receivable turnover of a potential borrower. Now, the higher the turnover, the greater the confidence of the lender regarding receiving payment from the borrower. Now, how do we calculate the account receivable turnover ratio? It is sales revenue divided by the average account receivable. Recall that account receivable is a balance sheet account, so we do the average. Now, for BNSF Railway Company, total revenues, that is sales revenue, is 19,548. Now, account receivable is 1189 for 2011 and 955 for 2010. Now, recall that the 2010 account receivable is the ending balance for 2010, which can be considered as the beginning balance for 2011. So we can calculate the average account receivable. We also have the sales revenue. So the account receivable turnover ratio will be 19,548 divided by the average of 1189 and 955. Now this should give us 18.2 times. Now recall that we can also calculate the average collection period, which is the number of days on average it takes the company to collect its account receivable. Now we want the average collection period, or the number of days sales in inventory, to be as low as possible, because you want to take fewer days to collect account receivable. And we calculate this ratio as 365 divided by the receivable turnover ratio. Now, we're not required to do that, but assuming we were required, we'll just do 365 divided by 18.2. So our answer for this question is 18.2 times. Now, moving on, we will look at the second set of questions, and still on operating assets, we will now look at property, plant, and equipment, and our focus will be depreciation calculations. Now, Haskins Company purchases a laser cutting machine for use in fabrication of a part for one of its key products. The machine costs $65,000. Estimated useful life is 5 years, after which the salvage value is $5,000. Now, the salvage value is the scrap value. That means at the end of the useful life of the equipment can be sold as scrap for $5,000. Now, we asked to compute depreciation expense for each year of the machine's 5-year useful life under the straight line method and the double declining balance depreciation method. And then we are also asked to use the financial statements effects template to show the effect of depreciation for the first year only. Now, let's start off with the straight line method, and we would go to the Excel spreadsheet and review the analysis. Now, the cost of the machine is $65,000. The useful life is estimated to be 5 years, right here. The salvage value is $5,000. Now, the straight line method depreciates the asset uniformly over the useful life of the asset, which means that depreciation is equal every year. Now, the depreciation rate is therefore 1 divided by the life. So for 5 years, we'll depreciate each year 20% under the straight line method. After 5 years, depreciation is 100%. Of course, we will be depreciating the depreciable cost, the portion of the cost we can depreciate, and that is the cost minus the salvage value. So we'll be depreciating, in actual fact, $65,000 minus $5,000. And the straight line rate is 20%. Now, what this means is depreciation every year under the straight line method will be 20% of 60,000. And that's what we have here. And how did we get that? We use the straight line depreciation formula, cost minus salvage value divided by the useful life. So there again, 65,000 minus the salvage value divided by the life. So 20% of the 60,000 is 12,000. So every year, depreciation expense is 12,000. So expenses will increase by 12,000. Net income will decrease by 12,000. And recall that accumulated depreciation is where we accumulate depreciation expense every year. We put it, it's like a bucket. We put the depreciation in it and then subtract the accumulated depreciation from the asset cost. Now let's go back to our financial statement effects template and reflect the transaction for the straight line depreciation. Now, the 12,000 is an expense which reduces net income, reduces earned capital. And then on the non-cash asset side, Recall that the depreciation reduces the value of the asset by 12,000. So accounting equation is balanced. Left hand side reduces by 12,000, right hand side by the same amount, 12,000.